Hi students, and welcome to the final video in the series on organizations and their reporting boundaries. Remember, this is just the theory part of the lecture. It's just meant to be lectures for Monday, the 20th of March, which means that you still need to come to class on Wednesday. On Wednesday, what we're going to be doing is we're going to be going through some more examples, doing more practical things in class. There will be a little bit of overlap. Don't panic. We will take you through that. So in today's lecture, let's have a look at what we've done and let's look at where we're going. So in today's video, you are going to be firstly, we've already spoke about in video one, we spoke about reporting boundaries. We spoke about how managers affect the reporting boundaries. We then also spoke about resources and how once you identify that a resource is important, you basically accept the responsibility to report on that resource. In the last video, in video two, we actually delved deep into that idea of costs. And we said there's costs to production, but there's also costs to reporting. Both of those costs can be things that we need to consider when deciding where our reporting boundaries lie. Remember, with costs related to operations or cost of the business, those are costs that we want to report on. And we spoke about private versus externalities. And then costs of reporting generally are costs that prohibit us from just reporting on every single cost because it's so it's so difficult and expensive to get that type of information. You remember in video one, we covered a little bit on inputs and outputs of an organization and how that can affect the reporting. So in today's video, we're going to be covering the section on frameworks, right? Reporting frameworks. We're going to be attaching that to outcome 9. So outcome 9 is where we also talk about frameworks and information related to frameworks. So that's why it's only come up now. So we'll do that in today's lecture. But again, just to look back at what we did in video 2, we spoke about the supply chain. Remember, we said companies might want to report up their supply chain as to what their suppliers are doing and how their suppliers are affecting, the ESG indicators. And companies might also want to report down their supply chain. How are their customers doing? What are their customers doing, etc. So that's what we did there. And then finally, we closed off about talking about how accounting is not a one size fits all. In today's lecture, like we mentioned, we're going to talk about the framework. We also want to cover management accounting. If we get to it, we will also just go over a little bit on what does it mean to be for profit or not for profit, and how we and why we need all of those organizations in our world. So that is our plan for today. Now, let me briefly chat to you about management accounting. So management accounting is a type of accounting that you will learn about. So management accounting and FDM, which you're going to do next semester, are linked, but the link is a bit not as strong. Uh, so management accounting is basically preparing internal information, so information for internal users of a business, right? You're preparing internal information so that they can make accurate decisions. Now contrast that with what we already know about external reporting, or what we study in RRP. Right? In RRP, we always say we want to make sure that people that look at our financial statements can make decisions. Those decisions are external to the business. They decide either to invest or de-invest. Those are external. That's not something that the business can control. Whereas internal decision making, for example, decision making about profit, decision making about cleaning the environment, decision making about how to treat workers, etc. Those are all internal decisions, and they need to be informed in order for them to be good, accurate, meaningful decisions that have an impact. So the people that are making these decisions, directors, managers, they need good information. And as accountants, we are the people that provide them with that information. So when we talk about management accounting, that's what it is. It's providing internal stakeholders with good quality information so that they can make informed internal decisions. That's the basis of management accounting. Now, you would understand that management accounting would need to meet many different requirements. For example, people can make a financial decision whether to rent or buy a building, for example. That's a financial decision. But you could also make human rights decisions, human resources decisions, whether or not to allow maternity leave to your female workers. That's those two decisions are very different. They're vastly different. Okay? And so management accounting needs to be so flexible that it can provide meaningful information for both of those decisions. That's amazing, right? Isn't that interesting? So what we find is that the standards for management accounting are a lot less prescriptive than the standards for financial accounting. Right. So they don't give you as much detail about how to compose, a report, for example. Whereas in accounting, there's very detailed information about how, when I say reporting, I mean RRP, there's very detailed information about how to prepare, for example, a financial statement. Right. That's number one. Number two, there's a lot of information in management accounting that is too detailed to release to the public. Right? For example, information about a company's competitive advantage, information about various risks that a company faces. Not all of this information can be disclosed to the public because some of them could result in, sabotage or the end of the company. So management accounting needs to provide specific information to specific users that help them make decisions, but it also needs to be flexible enough so that it can meet all the needs of businesses, and it needs to be detailed enough that it results in meaningful decisions being made. So that's what management accounting is. Management accounting is simply reporting to management. Okay. It's simply reporting to management. That's the first difference. The next difference is management is always an internal user and never an external user. So they're always reporting to themselves, which is interesting. Okay. What you will find, like we already mentioned, is that there's very little information for how to properly report on environmental, social, and governance impacts. The governance is getting better, but the other two are lagging behind a little bit. And so it's important for us to identify the frameworks that are applicable. So we just said in management accounting, there really aren't specific frameworks, but they're principles, right? For example, only including costs that are relevant to a decision. They're principles, never taking into account costs that can't be avoided. Those are called sunk costs. They're principles. And for RRP or financial accounting, there's standards, there's rules that we need to apply, all right? It's a bit more prescriptive. Okay, so we find that for the different types of accounting, you actually have different frameworks, different ways of thinking about this topic. In accounting, we have something called the conceptual framework. You don't know it yet, but when we are speaking about assets and liabilities, when we are speaking about accrual concept, all of that stuff was coming out of the accounting conceptual framework. So we already started a little bit of it, is what I'm trying to say. And so the differences in accountings result in a difference in the framework that's used. Now I want to briefly just touch on not-profit and profit organizations. So as the name implies, companies that are not-for-profit do not make a profit. This does not mean that their income is not higher than their expenses. That's not what it means, right? You can have a not-for-profit organization that very well and consistently has a higher income than it has expenses. Okay? All it means is that, for lack of better word, earnings, right? Those earnings are never distributed to the founders or the owners of a not-for-profit organization. So it's not really from the perspective of the company that these words are being used. It's from the perspective of the owners. So from the owner's perspective, they never see any profit, right? So even though it's called a not-profit organization, the organization can make a profit, but the owner will never see it. So it's from the owner's perspective, they have a not-for-profit organization because they never see any profit. The opposite, obviously, is what we are very familiar with, a profit organization. Most companies are profit organizations, and profit organizations are designed to make income and sustain themselves, but also issue or give some of that income, some of that profit to their owners, and those are sometimes called shareholders. Okay, so that is the difference between profit and not-for-profit organizations. Now, the question might be asked, why then is a not-for-profit organization in existence? If it doesn't make a profit, what's its benefit? What you will find is that not-for-profit organizations generally have some environmental or social cause that they are trying to promote. So their main purpose for existing is, yes, not to make a profit, but it's also to improve the lives of either people or to improve the environment. So it is critically vital for these entities to exist and for these entities to make a profit. For example, let's consider in South Africa the CA. That is an organization that takes care of animals. What you will find is that if they did not operate, the animals would be worse for wear, right? They would suffer. So what we need to do as responsible individuals is make sure that these not-for-profit organizations that are doing good work do continue to perpetuate and continue to exist by making sure that they do make a profit, but just not distribute it to their owners. Okay. Now, I want to quickly talk about some forms of a business. So the first thing that you need to know is that a type of a business can be either profit or not for profit, and then the legal form of a business, right? So from the one, we're looking at it from an accounting perspective. Are they making a profit? Are they not making a profit? Those are entity or organization types. The forms of organizations is the legal documentation. How are they represented? What do they look like from the law's perspective? That is what we want to talk about now. Okay, so all of these organizations can be either profit or not for profit, because that's looking at it from an accounting perspective. So that's the important thing. Sometimes when we talk about this, students get the accounting substance or the accounting lens mixed up with the legal lens. and so they're not understanding what we're talking about. The first type of organization that we are going to be discussing is going to be a sole trader. Now, you guys are more or less familiar with a sole trader from RRP. Some of the things that are interesting about a sole trader is that, number one, it's very easy to set up. In South Africa, there are no legal documents that you need to submit. You can literally start sole trading today if you wanted to, right? So it's super easy to set up. It's generally characterized by a owner manager. So the person who manages it on a daily basis is also the owner, which means there's no separation between ownership and management. Therefore, that sort of breaks down the ideas that we normally talk about in a agency theory. Now, not only is it easy to set up, it means that the owner manager has absolute control over what the entity does. Right? So they're very influential. The sad thing about it is that when that owner manager dies or retires, this sole trader ceases to exist. Okay, so that's a bit sad, scary. The other thing is that we talk about unlimited liability, meaning that if the sole trader does something, right, that results in a lawsuit or obligation being raised, right, from a legal perspective, the business doesn't exist. And therefore, the law will go after the person, the owner behind the business, which is a bit interesting. Because remember, from an accounting perspective, we want to keep the business very separate from the owner. But from a legal perspective, when it comes to a sole trader is considered a person, and therefore, if the business does something bad or not good, you can go after the owner of that business for all that he is worth, right? So whatever he's worth and even more, you can go after him for that. So that is the unlimited aspect of the unlimited liability aspect of a sole trader. It's good in a way because all the profits of the business that are made then belong to him. So also all the costs and liabilities of the business belong to him. The one thing is you find that in these owner-managed businesses, there's not a lot of good accounting that goes on, right? So you find that the accounting is very subjective, very much dependent on what the owner wants, how the owner wants it. It's simply just to make decisions, just to allow the owner to make decisions. And so they are our main reporting boundary. There will be an extended reporting boundary to, for example, banks or funders if there's a large liability contingent in the business. And then finally, every year we'll have to submit a tax return. So that will also be a reporting boundary that we'll look at. So you find that the reporting boundaries are not very far off. It mainly deals with private costs, mainly deals with things close to the business. And so that is how a sole trader generally operates. The accounting is very much dependent on the needs and wants of the owner of that business. The next type of form of organization that we want to talk about is partnerships. So partnerships are generally in South Africa between 2 and 50 people that come together. And now this is an important thing that needs to be said. In your textbook, it talks about between 2 and unlimited number of people. That's incorrect. In South Africa, it's 2 and 50 people. Right? A partnership can only be made up of 2 and 50 people. So with a partnership, they come together, they generally have what they call a partnership agreement that they sign, and you'll see in your class notes, I go into detail about the partnership agreement. And in the partnership agreement, you would have things like how do we share profits, who does what are the requirements and responsibilities of each partner, etc. Firstly, it's fairly easy to set up. Again, there's not much legal documentation that needs to be filed. The one negative is that they have mutual agency, meaning that each member of the partner can make a decision on the behalf of all the members of the partnership. So that can result in trouble, mainly because partners might not always agree with the decisions that the partner takes. Profit sharing and risks are shared in a partnership. Generally, that is determined by what the partnership agreement says, right? When we look at why it's nice to have a partnership, you'll find that not only is the profits, the risks at least, are shared, you find that a partnership can actually have the ability to raise more capital because there's more people contributing, and can have specific technical skills because each partner will bring his or her own set of skills to the table, and that can actually result in quite a good mix of skills in a business, and so it can actually help propel a business forward, which is quite nice. Then we want to look at some disadvantages. Firstly, there's unlimited liability, similar to what we saw in the sole trader, which means any or all partners can be sued for any or all of their net worth, and in some cases, even more than their net worth. So that is, not the best thing. When it comes to accounting, what you'll find is that there are some particular accounting anomalies. For example, you'll need a capital account for each partner in which you record the capital. You'll have a drawings account. You'll have what we call current accounts, which is where accumulated profits and drawings come out of, if it needs to happen like that. So those are sort of accounts that are specific to partnerships. However, the need to report, whether or not we do report, is really dependent on what the needs are of the partnership and what the partners want. So what you can find is, just like a sole proprietor, we can have a situation where we actually don't report a lot on partnerships. And that's because the partners don't see the need, right? So that's important. And then finally, a partnership, just like a sole trader, dies when any of the partners die, or when any of the partners want to leave. Then the partnership dies. Right? So if there's any change in ownership, the partnership is unstable. Okay. So if we look at reporting boundaries, obviously each partner is a reporting boundary, so that's going to be your owners. And then extending past that, it's going to be creditors and debt providers. So those are going to be ones that we want to look at. And then finally, the government via taxation is going to be something that's important. You will not find many partnerships collecting ESG information or environmental, social, and governance information. They're mainly going to be focused on the financial side of things. Partners will want to know what their other partners are doing and what they're doing in relation to their ownership in the business, and in relation to the things like drawings, etc. So that is some information that needs to be included in the financial statements and reporting of a a partnership. Partnerships do produce financial statements, but it's not required that they produce it. So it can sometimes not happen. Okay, so that's where we're going to leave it for this video. So this is the last video in our series on organizations. I would encourage you to either contact me via the contact cards on Bus 100, or you can go onto RP, and I've also got a link there in any of the sections that I lecture. You can see a QR code to go and book an appointment with me if you need any help dealing with the section. But that's all. I hope to see you guys on this coming Wednesday. Bye.